Hey y'all, what's up? This is Magda from Crypto Masters and I hope you're having a great day so far. Now, I've got a new series for you and it's called Crypto ABC. I dedicate it to those who are at the beginning of their cryptocurrency adventure, just in case you need a helping hand and a few kind of information compilations. Today's episode is about arbitrage, what it is, how it's done, and what to watch out for. So let's start at the beginning. What the hell is arbitrage? Well, it's actually nothing else than the good old technique of buying cheaper and selling at a higher price without taking any unnecessary risks. So in our case, it's all about buying a cryptocurrency at a lower price on one cryptocurrency exchange, and you guessed it, selling it for more at another cryptocurrency exchange. One of the most important aspects of arbitrage is finding a product with two different prices in two different places, so you can take advantage of that price disparity. And I guess it's kind of obvious, but it's got to be said, arbitrage is only successful when you've made sure that transaction costs are lower than the potential price difference. So arbitrage relies heavily on the mechanism of disinformation, hence not everyone knows the same things as everyone else. Now, I did say that arbitrage was the good old technique of buying cheaper and selling at a higher price, right? So this is quite traditional and has been functioning on traditional markets and exchanges for decades, if not even like a century. And just to kind of illustrate this, what does arbitrage look like on traditional markets? Well, arbitrage transactions are made simultaneously on two markets, often thousands of kilometers apart from each other. Imagine that Microsoft stocks are listed for $30 at a German stock exchange, while at the same time they're listed for, say, $32 on NASDAQ in the USA. So what do arbitrageurs do? Well, they buy the undervalued, cheaper stocks in Germany and sell them in the States. In reality, a price difference between stocks of $2 is next to impossible on ordinary exchanges. And when there are price differences, there are usually only a few cents on a stock. So engaging in arbitrage or using it as an income strategy isn't too profitable when it comes to traditional exchanges, not mentioning all the transaction fees which we have to deduct from the profit. So keeping all this in mind, it's usually only the big fish that can make any decent money on traditional exchanges, as the only way to earn is by trading in larger volumes. All right, now why is arbitrage more profitable in the crypto sphere rather than on traditional exchanges? Well, it all boils down to three factors. First of all, the cryptocurrency markets are characterized by a high inefficiency. Each cryptocurrency exchange is an independent company with different amounts of users trading in different volumes, etc. This means different levels of liquidity, which means that you'll have different kind of selling and buying times. Each cryptocurrency exchange also reacts differently to changes coming from the market. That's why there are so many arbitrage opportunities in the cryptocurrency exchanges, and that's why price differences are higher than on traditional exchanges where supply and demand are on the same level and reflect reality. So here you can see the three factors of classifying a given exchange as efficient. This theory is called efficient market hypothesis, and we've got three forms of this hypothesis, and I don't really think that cryptocurrency exchanges even fulfill the first one, which says the weak one, and here I quote, the weak one states that prices on traded assets already reflect all publicly available information. Now, this is not the case. If you're kind of really got your crypto antennas tuned into the market, then you can really kind of find pieces of information. It can be just like a tweet or something, or a low-key news channel will broadcast. So basically it's just really information inefficient. The next factor is that cryptocurrency markets are full of follow the herd psychology. So the number of inexperienced investors on cryptocurrency markets are way higher than on traditional ones. The promise of from rags to riches is proving, unfortunately, a lethal attraction to people who are completely unaware of the mechanisms of fake news and disinformation. And then we have all these people running to their grandmas to lend money to buy Bitcoin. And, you know, the moment they hear that some expert said that Bitcoin is going to keep mooning for eternity, and then they're also the ones that panic sell with a loss the moment Bitcoin drops a few cents. You know, not even going to go into pump and dumps and other phenomena that are hard to stay on top of for cryptocurrency exchanges. And last of all, cryptocurrency exchanges are still largely unregulated. Yep, it's still that argument. There is no large financial institutions on the cryptocurrency market that could regulate and consolidate the exchanges. Consolidation would also kill arbitrage opportunities. So it's a double-edged sword. Right, what do you need to start your arbitrage adventure? Well, first of all, you need to have money to invest or trade, however you prefer to call it. And it would be best if the loss of this money didn't result in the bailiff's visit, if you know what I mean. Second of all, you need to have an account on 2 cryptocurrency exchanges. Or your good mate needs to have an account on one crypto exchange and you need to have one on another. You also need to understand where cryptocurrency prices come from, what they are influenced by, and you need to be able to use CoinMarketCap, right? But we'll get back to that in a second. You need to be aware of transaction fees. You need to know how high they are so that you can calculate the profitability of any given transaction. You need to remember that transaction times will not be your friend, so you need to calculate that into your risk margin. And last of all, you need to have Bitcoin, Ether, or Ripple, or preferably all of them, to be able to grab more opportunities when they do come up. The 3 main cryptocurrencies are usually the operational units on any given crypto exchange, and you need to, you need them to purchase less popular tokens. So when you're all set up, let's have a look at how arbitrage is to be carried out. Well, there are a few camps here, but I'll show you the most basic one. So you go on CoinMarketCap and you select a cryptocurrency. Okay, so usually it's the less popular ones that you're going to have larger price discrepancies on. So I don't know, I'm just going to go right to the bottom. Let's have a look at gas. Once we've selected our cryptocurrency, we have a look at the markets tab right over here. And this is where the fun begins. So first of all, obviously you can sort them according to price. I personally prefer to sort them according to the currency pair. I prefer this because it's easier to see what options are available to me based on what operational units, by this I mean Bitcoin, Ether, etc. I'm using. So, we can see that here we have a discrepancy of 14 cents, which is quite a lot actually, or even more here. Now, another thing you need to notice before you go all crazy with the prices is the 24-hour volume, okay? I would not take into consideration any crypto exchanges that have a 24-hour volume below $1,000. So if you eliminate this will help you kind of get rid of any dodgy or dead crypto exchanges, okay? And now, as we said, let's go back to the slightly boring and tedious phase. But remember, if this was dead easy, everyone would be doing it. So now you need to have a look and find the lowest price and the highest price here, taking into consideration the 24-hour volume, making sure that the crypto exchange isn't dodgy or isn't dead. Right, now when you do choose 2 exchanges that you're happy with, you need to check all the transaction fees. Now you can also see this on CoinMarketCap. So let's say I've selected OKEX. And here we've got all the fees. that we can expect to pay, all the kind of conditions. So you really need to take this into account to make sure that your arbitrage is profitable. Okay, but fortunately, you don't need to carry out this time-consuming process manually. There are different kinds of market scanners that will do this for you, that will make your life easier. So they don't only function as a kind of search filter, but they also give you information about the market depth and transactional volume. So this last thing lowers the risk that your buy order will be too big and there won't be enough cryptocurrency with the price rate that was profitable for you. So, your transaction won't get frozen because you only get 80% of what you wanted to buy or sell. So it's really important to check this. Okay, so here on Crypto Wizards, you go to ArbScan and you've got all the percentages, all the profit kind of percentages that you can make. And if you want to check the depth of the market or the volume of the transactions, it's available here. And just so things aren't too sweet, fuzzy and mellow, let's get down to the actual risks of arbitrage. Now, I did mention at the beginning that traditional arbitrage is pretty much risk-free. Well, yeah, traditional arbitrage is risk-free, but it also has lower earning opportunities. Whilst crypto arbitrage, because the market and the crypto exchanges are highly unregulated, you get higher possibilities to earn more money, but also you get a lot more, let's say, threats or a lot more risks. So the first risk that we should concentrate on is the actual crypto exchange, right? The cryptocurrency exchange that you're going to be using to buy and sell your cryptocurrency. Let's say that you found a crypto exchange with a good 24-hour volume on which the currency you want to sell is quite expensive in comparison to the price that you bought it for initially. Great. But now the important thing that remains before you can say that you've carried out successful, profitable arbitrage is being able to cash that money out, or simply being able to return it to your home cryptocurrency exchange. So let's say you found an incredible arbitrage opportunity on a foreign crypto exchange. No problem. But before you decide to continue with the transaction, make sure to check that there aren't any payout restrictions, because these do happen, So basically withdrawal restrictions. Sometimes you have like a limit, a daily limit, or sometimes you have actual fees that accompany with money withdrawals. So if you ever had a situation in which you had problems paying out or transferring your capital from a cryptocurrency exchange, you can always change the currency to one with a similar price and then transfer it to the home crypto exchange. Not to mention the danger of the crypto exchange just dying or going bankrupt or getting hacked, etc. You need to be aware that it's the very crypto exchanges that offer the largest spreads, meaning the largest price differences, that are the most unstable. So be careful not to fall into that trap. Is there any way to secure yourself against these end-of-the-world scenarios? Sure there is. If you have a decent amount of capital to trade with, crypto exchanges will love you up and offer you the best secure conditions, comparable to brokerage firms on traditional exchanges. Then the money lying on your account is safe, irrelevant of how well the exchange is performing. On regulated exchanges, your money is controlled by the SEC and other financial institutions or brokerage firms which manage your transactions, and your money doesn't actually sit on the exchange. So that's not how it is that's not how it is on crypto exchanges. Some safety precautions you could take are, for example, keeping your money on your own account, in your own wallet, or trading on the basis of bank crypto exchange contracts. The next barrier to easy money is transaction time. And here both the crypto exchange and the blockchain can be at fault. So don't count on it that the transaction time of your juicy transaction is going to go as planned. Here you can be met with a few serious difficulties, starting with the time necessary to put a transaction on the blockchain, where sometimes you need a concrete amount of confirmations before your money passes through the authorization process and is booked onto the blockchain. And we all know that everything can change in 10 or 20 minutes, including the price of the cryptocurrency that you wanted to trade in. Not even mentioning the actual exchange being overloaded, or platform maintenance, or blocked wallets in the worst possible moments, or going bad to worse, intentional sabotage on the part of the actual crypto exchange. And stuff like this does really happen. In other words, it's called front running. So what front running is basically using information about incoming transactions, thanks to which the other side can anticipate your move, buy out all the cryptocurrency from the market, and kind of block you. Cryptocurrencies are not regulated. No financial institution is making sure that they are playing fair, that they're not kind of doing anything that would be considered illegal. So sadly, this gray zone is often misused to generate profits for the cryptocurrency exchanges themselves, by themselves, for themselves. It's enough that an exchange has a programmed bot which detects a larger order and the exchange adjusts in its own favor. A second is literally enough. Concluding, crypto arbitrage truly is a double-edged sword. On the one hand, the lack of regulation and inefficiency gives larger arbitrage opportunities. But on the other hand, these very same factors cause the exchanges to be unstable and not always honest. What do you think? Is crypto arbitrage worth it? Does anyone have any experience they could share? Many thanks for your time and attention, and I'll see you in the next video, and have a lovely day.